When it comes to investing, we throw the word risk around all the time. But what if I told you we've been thinking about it all wrong? It turns out risk isn't just one big, scary thing. It's actually two completely separate ideas. And really understanding that difference, well, that's the key to a much, much smarter investment strategy. Today, we're going to break down the crucial difference between your willingness to take a risk and your ability to take a risk.
Okay, let's start with a fundamental truth, something our sources make crystal clear. Every single investment involves risk. There's just no getting around it. So the goal isn't to find some magical risk-free investment, because that just doesn't exist. The real goal is to understand risk, to manage it, and to make it work for you instead of against you.
And that right there is the big question we're tackling in this explainer. Because risk isn't some abstract thing floating around in the market. It's incredibly personal. We're talking about your money, your goals, and frankly, your ability to sleep at night. What feels risky to one person might feel perfectly safe to someone else. So how in the world do you figure out what it means for you?
All right, so here's our game plan. We're going to start with the risk puzzle. Then we'll help you meet your risk profile. After that, we'll dive deep into risk tolerance, that's the mindset part, and risk capacity, that's the math. Then we'll figure out how to find your sweet spot, and finally, how to move from a strategy of hope to control.
Okay, let's dive right in. Section 1, the risk puzzle. Why does this whole topic feel so darn complicated sometimes?
Well, the short answer is we're trying to plan for our future in a world that is, by its very nature, completely unpredictable. You've got news events, economic shifts, random tweets. All of it can send markets moving in ways nobody saw coming. And without a solid framework, it's so easy to feel like you're just a passenger on a roller coaster, totally at the mercy of the market's whims.
So look, the job of an intelligent investor isn't to have a crystal ball. It's to build a system that can handle the unexpected. It all starts with just admitting, okay, risks are real. From there, it's about developing the right temperament. That's the emotional strength to not panic sell when things get shaky. Then, you learn the practical skills to control what you actually can control. And the ultimate goal? It's making decisions based on a clear, repeatable strategy, not on gut feelings like fear or greed.
And now we get to the solution to this puzzle. The big secret is that we can take this huge, scary idea of risk and break it down into two simple, manageable parts. Getting this distinction is the absolute key to clarity.
Okay, this slide right here, this is the heart of our entire discussion. On one side, you have risk tolerance. That's your willingness to risk. It's all psychological. It answers the question, how do you feel? On the other side, you have risk capacity. That's your ability to risk. This is pure finance. It answers the question, what can you afford? They are not the same thing, and you absolutely need to know both.
All right, let's dig into that first piece of the puzzle, risk tolerance. This is all about the psychological game of investing, what's happening inside your head when the market starts to get choppy. So, what is risk tolerance? Put simply, it's how much of a market swing you can stomach without freaking out and selling everything. It's shaped by your personality, your life experience, your age. It's deeply personal. But here's the thing. It's incredibly easy to think you have a high tolerance for risk when the market is going up. The real test is when your portfolio is down 20% and every news channel is screaming about a crash.
To really get this, our source material has a fantastic analogy. Let's just forget about stocks for a second and think about vehicles.
I mean, think about it. A giant 747 airplane flying miles up in the air. That sounds incredibly risky, right? But with a highly trained professional pilot in the cockpit, it's actually one of the safest ways to travel. Now take a high-performance BMW, a car engineered for safety, but put a drunk teenager behind the wheel and it's an incredibly dangerous weapon. The point is, the investment itself isn't the only thing that matters. The skill, the education, and the temperament of the investor are just as critical.
And this brings us to what might be the single most powerful idea we're going to talk about today. The best way to manage your psychological risk, to improve your risk tolerance, is to get educated. The more you learn about how markets work, about your specific investments, about your strategy, the less emotional you become. You stop being a nervous passenger, and you start becoming a calm, confident pilot.
Okay, so we've talked about the psychology. Now let's get down to brass tacks. We're switching gears from the mind game to the numbers game. This is risk capacity, and it has absolutely nothing to do with your feelings and everything to do with the cold hard facts of your finances.
Risk capacity is all about the math. It's the amount of money you can actually lose without putting your critical financial goals in jeopardy. Things like retirement or paying for college. It's a function of your time horizon, your income, your net worth, and unlike tolerance, this isn't subjective. It's a number we can actually sit down and calculate.
So that's great in theory, but how do you actually use this number? Well, the main tool in the toolbox here is something called position sizing. This is a core technique that professionals use to make sure that no single bad investment can blow up their entire account. It's all about playing defense.
So, a really common rule of thumb you'll hear from professional traders is the 1% rule. This just means they will refuse to risk more than 1% of their entire account on any single trade. Now think about that. If they have a $100,000 account, they will not allow themselves to lose more than $1,000 if one of their ideas goes totally wrong. This discipline is what keeps them in the game, day after day, even after a string of bad calls.
All right, let's actually walk through the math so you can see exactly how this works. Let's say you have a $100,000 account. You decide on that 1% risk rule, which means your maximum loss on one trade is $1,000. Okay, now you find a stock you like at $39, and you decide that if it drops to $37, you're out. That's your exit point. So your risk is $2 per share. Now for the easy part. You take your max dollar loss, $1,000, and divide it by your risk per share, $2. What do you get? 500. That's your position size. You can buy 500 shares, and now you know, with certainty, that even if you're totally wrong, your loss is capped at that 1% you planned for. That is how you control financial risk. So we've broken down emotional risk tolerance, and we've done the math on risk capacity. Now let's talk about the sweet spot, and what happens when these two things are out of whack, because this is where a lot of investors get into serious trouble.
This is where things can get really dangerous. On one side, you've got the daredevil. This person has a super high willingness to take risks, but they have very low financial capacity. They're ready to bet the farm, but they literally can't afford to lose. The result? A huge potential for a complete wipeout. And on the other end, you've got the worried millionaire. This person has a massive capacity for risk. They've got the money, but a very low psychological tolerance for it. They're so terrified of losing a dime that they hide their money in places that can't even keep up with inflation. And the result there is stagnation.
Let's make this super real with a case study that comes straight from our sources. Picture a 75-year-old man. He's still working, and he only has $5,000 in savings to his name. And right there, you see the conflict, don't you? A financial advisor looks at the pure math, his risk capacity, and says, "You have so little, you cannot afford to lose a single penny of this." That's the low capacity argument. But the man himself feels desperate. He says, "Look, if I don't take big risks, this money's going to be gone in a few months anyway. I have to be aggressive to even have a chance." That is a high-risk tolerance argument, driven by pure necessity. So, who's right here? It's a tough question, and it perfectly shows the tension between what you can afford to lose and what you feel you need to risk.
So how do we solve these kinds of problems? How do we find that balance? Well, it all comes down to a really fundamental shift in your mindset. It's a shift from being a passive passenger who's just hoping for the best to an active pilot who is in control. Listen, if there's one word you need to be wary of in your investing vocabulary, it's hope. When you hear yourself saying, "I really hope this stock goes up," or "I hope the market recovers soon," that is a huge red flag. It means you've lost control, you don't have a plan, you're basically just gambling. Control, well, control sounds totally different. Control sounds like, my position size is calculated to limit my loss, or my exit strategy is to sell at this price. See the difference? Hope is a wish. Control is a strategy. And this is maybe the most empowering thing to remember out of all this. You can't control the market. You can't control the economy or interest rates, but you have 100% control over a whole bunch of really powerful things. You control your own education, you control your position size and your exit strategy, you control your spending, your savings rate, and who you choose to work with for advice. These are the levers you can actually pull to shape your own financial future. So I want to leave you with one final question to think about. Is your financial plan built on hope or is it built on control? Knowing the difference between your risk tolerance and your risk capacity, that's the very first step toward making sure you have a strategy that gives you the right answer.